Hello, everybody. Trust you're well. Really good to have you back on this session. It's an exciting time for me as well. I hope you also been keeping well throughout this lockdown period. You've been staying safe, staying hydrated, staying exercised mentally and physically and spiritually, keeping feet all round. Um, my name is Tux, as you all know. I have the privilege of, being in this amazing group, an amazing school, and we're always looking to give you, um, you know, brilliant sessions and trainings at all times. Okay. Um, Today, what we're just going to be covering is we're going to be covering what we've gone through from last two sessions. So we've been able to do two sessions, and in the two sessions we covered a few things. So this is for some of you guys that have missed those two sessions, or some of you that was there but you didn't understand. This is a good way to merge those two lessons together and have a better understanding going forward. I'm confident that at the end of today you will have some more light shone at every one of the issues that you have regards to trading. Okay. So here goes. We're gonna go through the first um, session that I had with you guys. So in the first session that I had with you, we went through what we call market structure. You know, the uses of market structure and the types of market structure. So we looked at market structure. We looked at the types. Then we looked at market structure break, the directions, how we use them to get our direction and the types of direction that we have in the market. Okay, that's what we covered. And straight away, market structure, from the definition and example that I gave last time, um, what you need to understand is price always moves, never moves in a straight line up or moves in a straight line down. It never does that. Okay, it always moves, in a way such that it breathes. Okay, it breathes, so it goes up, retraces a little bit, then goes up, retraces a little bit, then goes up. If it's coming down, it does the same. Okay, so we were then talking about market structure, and the first thing I pointed out to you was how structures were made. So the first example I'll give, let's talk about bullish structure. So bullish structure occurs when we are having a series of higher highs forming, okay, and a series of higher highs. So we move high, a series of higher highs forming. So here you have a high here, and market moved up and gave us another high. Market moved up and gave us another high. So the first thing that I did was I identified to you how this levels, what they look like. Okay, what they look like. So all this moves, this swings, how they look like, and that's what forms, the structures, what makes a structure and all that stuff. Okay, so we looked at an example quickly. So those points that I highlighted earlier, when you're looking at the very high of any move, you will see this kind of candle formation there. Okay, this is the first thing that I was talking about. So at every point, at every high that you have, swing high that you will have three candles this way. The middle would have the highest high, whilst it will be higher than the lows of the two candles to the left and to the right of it. That forms that V shape over there, or that swing high over there. Okay, just three candle formation. The middle will be the highest point, and then you'll have two other candles, one to the left, one to the right, that is lower. Okay, So that was the first thing we looked at. Then the next thing we looked at was how the swing structure for the lows look like. Is the same thing, but it's just inverted. So for the lows, still 3 candle formation, but we have the middle one is the lowest low, and it's got 2 other candles to the left, a candle to the left and to the right, that their lowest lows are higher than the middle low. So the middle candle in a swing low will be the lowest point of the 3 candles. Okay, and whilst for bullish structure, the middle candle will be the highest point of the 3 candle. Okay, very, very simple to understand. Very, very simple to understand. Okay, so once we establish that, now so now we know how these structures look like. So this is a bullish and this is a bearish. Okay, so um when we are having a series of higher highs, you'll be seeing this at the very tip, but you'll be seeing them created at higher levels. When you're looking at lows, you see this formation and you see them. If we're bullish, sorry, the lows would not come to violate the previous low. It will be called something they call a higher low. Okay, so this is a low, but it is higher than the previous low. That is why it's called a higher low. Let me clarify this again. So this is a high, but this high is higher than this high. So this high will be called a higher high. Okay, a higher high. So in a bullish trend, we will always have. So now, I'm now taking us to bullish structure. Whenever we're in a bullish structure or in a bullish pattern or bullish direction, you will always have a series of higher highs, higher highs. So you have a series of higher highs and you have a series of, so this will be a low. So this first point is low, but this next point is a low, but it is not lower than this low. So this will be called a higher low. That's a higher high, and the move down is a higher low, provided it doesn't violate the previous low. Okay, that will be called a higher low. Okay, so this is the characteristic of a bullish structure. Okay, I'll reiterate again. In a bullish structure, we have a series of higher highs, HH, and a series of, so this is a low, that'll be a higher low. Okay, but the main one you want to look at is we're going to be having higher highs in a bullish structure. And at the very point at the top here, you would always see this type of candle structure. Okay, very, very simple. You will just have this 3 candle structure, the center being the highest, and it's got the one to the left and to the right that are lower than the candle. Okay, so in a bearish structure, how does that look like? In a bearish structure, we'll be having a series of, so if in a bullish structure we have a series of higher highs, what do you think about in a selling scenario? We would have a series of lower lows. Simple as. Okay, let me draw that to you. Okay, so you can see. So what is a characteristic of a bearish structure or bearish trend? Remember this very top here, you're going to be having this candle formation there, and these bottoms here, you have this candle formations there. So we would also have, so we go to our higher high and higher lows again. This point, you agree it is a high, yeah, but price came down, creating a low. Price rallied up, It didn't go past this previous high, so this is a higher low. And then price came down, went past this low to give us something we called a lower low. Okay, a lower low. And then it will continue that way. It continues that way until the higher low is broken. And then when the higher low is broken, the next swing forms is going to be called something else. It will be called a higher high because it's higher now, higher than the previous high. Okay. So for a bearish scenario, we're going to be having a series of lower lows. So you'll be having a series of lower lows. So this is a low, is a lower low. This low is past this low. It's a lower low. When these drop further past this low, it becomes a lower low here. So, and then you have a series of, you know, so this will be high, but this is a higher low. It is a high, but it's not as high as the previous. So it's a higher low, a high that is lower than the previous low. Just you can look at it that way. So this high, it's a high that is lower than the previous high. So it will be called a higher low. Okay, brilliant. So after we've been able to identify that, the next thing we then moved on to um, is something we call market structure break. Okay, market structure break. Now, market structure break is simply, let me use this as the example again. When we have market structure break is when we either have market structure break. Let me tell you about the use first. So the first use of market structure break is it helps us to identify change in market direction or continuation in market direction or um, a point in the market where you don't have to do anything. Okay. So I'll show you the three scenarios, okay? Market structure break. Market structure break helps us with direction, and we have three types. The first one is a bearish market structure break where we have lower lows forming, okay? We have lower lows forming, but this is when market structure break happens. So this is a high here. So let's assume this is a low. So we got this low here. Price rallied up, came down, or went past this low. Remember what we would have in that low would be this candle pattern, three candle pattern. Okay, this is a market structure, right? It's a structure. And so when price went past it, if price goes past something, we call it's a break. That's why it's called market structure break. Okay, let me do that again. So this level over here, let's change the pen. So we have this move down, created this low. Price came down, so let's project that level out. Price came down or went past that low. That becomes a market structure break. We call it MSB for short, okay? It's a market structure break. So it breaks that structure. Now it's forming a lower low. That picture, that scenario, forming a lower low, okay, creating a lower low, breaking this three candle structure here at every point. Look, there's another. So extend the low out. Price rallied up a bit, but didn't go past this high. It created a higher low, drove down again, went past this structure level here, created what? Another what? Lower low. Once that happens, this is telling us we're in a bearish condition where we have lower lows forming. So lower lows form when lower structures are broken, okay? Price goes past it and closes below that structure, goes past it and closes below. So this is a bearish structure. And as it's breaking the structure, it's going to be called market structure break. That is what is called market structure break. Okay. Now, The same thing can be said for a bullish condition. Okay, for a bullish condition, let's do it this way. Okay, so on your chart, it's not going to be as pretty as this. Okay, it's going to be like you have variation of different movement, of different bullish movement, but we're just looking at it in the, supposing the market is perfect like this, so it will be, you see, clean and clear this way, but they're not, they wouldn't do that for you because they don't want to give much away. Anyway, so now we now have a series of, so this is a higher low, this is a high, market went past that high, this will become a higher high, and price came back down but didn't go past this, sorry, this low, so we call this a low. So this becomes a higher low. Price went past this level again. It created another higher high. Remember, at every low, we have this 3 candle formation here, and every high, we have this 3 candle formation. When price goes past this price level over here, it is called a what? Market structure break. Okay? Market structure break, remember, helps us with telling market direction or market decision. Okay, so as we have that breakout and price closed above that level, it's clear, that's our first indication that price is going up. So every time you see a new high being broken, okay, that means we're in a bullish scenario, and that's a bullish market direction. Okay, so we having a series of higher highs forming, going past the previous highs. That is a bullish direction for the market. Okay, and we have looked at the other scenario for the sell. Okay, now what I want you to do is just quickly take the next 10 seconds, pop up your chart, and just get your pen and paper. Sorry, your pen and paper or your pencil, and then I want you to just draw out a series of higher highs, label them like I did, and I want you to draw a series of lower lows. Okay, series of lower lows and higher highs. So let me help you label this as an example. This is what I would like you to do. This is a high, okay, because the first one, this is a low, the low. When price moves up above this previous high, this new high becomes a higher high, higher high. And this new low over here becomes a higher low. Okay, so you can scrub this video back if you want to, if you're watching it later. And those of you looking at it now, I want you to do this example straight away. These work straight away. So when it breaks higher, it does a higher high. When it comes from a little lower, that is a low that is not as low as the previous, that's a higher low. Okay, yeah. And the scenario is the same thing for forming lows. Okay, so I want you to be doing this now. I want you to do this on your chart right now. Okay, no excuses. Do this now. Get a pen and paper, because if you get this burned in the back of your mind, then you will never stop seeing it. You'll be able to see it easy. But I'll also show you another easy trick for you to see structures like this in the market. Okay, so we're gonna call this so we have this first level here. It's a high. It's a high here, and then this level here is a low, and then it went higher, but it did not go past the previous high. So it will be called a higher low. Okay, it's a higher low, and then this next level here, because it went past the previous low, this low over here, this level, it broke it. What is a break of a structure? What's it called? Answer that now. So when it forms another level there, it will be called a lower low because it is lower than the previous low. Okay, so this is the bearish scenario. Okay, so I'm sure by now you guys have all plotted and drawn this out. So we'll move on. Okay, we'll move forward. Right. So if you have any question, please type them up and send it into the group, and we're more than happy to answer that question. Okay, right? Okay, so the next thing that we did, the next thing that we covered after we finished this session, we then move ahead to discuss another one of our pillars in this trading group. One of the other pillars in our trading group is called of our trading philosophy. Sorry, is called stop-ons. Okay, and we showed you how to identify stop-ons. Okay, so here we go. Let me clean this up. Okay. Okay. So this is the next thing that we looked at stop-ons. Okay. So we looked at the type of stop-ons, bearish stop-ons, the formula for a bullish stop-on and the formula for bearish stop-ons. Okay. And we looked at the theory and the phenomenon behind stop-ons. Okay. So stop-ons, I asked you that if you looked at your candle charts, mainly look at the daily, that at every major turning point, okay, you will always see something like this. Okay, you see something like this. You will see something like this. So you see a candle with a wick at the top, and then you see another candle that wicks past the high of the previous candle, and then comes back and close below. Okay, and then from then on you see the market move down aggressively. I try to represent it with this crude candle drawing. Okay, so the question is, what is happening around this level? Why is the market doing this? Why is the market going past a previous high or a previous low, just spiking it, closing below, and then boom, travels the other way? This always happens a lot for reversal when the market is ready to reverse their direction. So maybe they've been going long for the week. Okay, they've been going. So they've been. Where's my pen? Let me use this. So the market has been going up, breaking structure higher, higher, and then all of a sudden they just spike the previous high, and then boom, they do this aggressively down, reverse. Okay, or you see prices been going lower, 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 and then you just see one more spike of a previous low. It doesn't close, and then boom, direction changes, should notice something is happening here. Remember from the first recap, all these levels are called what? Come and answer them. In a downtrend, when you're forming lows, what are the lows called? You should remember that. That should be fresh. The lows are called lower lows, okay? And what are the highs called? They are called higher lows, okay? Right. So this happens. It spikes the most recent lower low and boom, moves the other way and goes past the higher low that we have. When it goes past the higher low and forms a new high, that will be called what? What will be a new high called? Remember? It is going to be called a higher what? Going to be called a higher high, right? Okay, so what I just did to you now is exactly what is happening there. So you see, this day, everything has been going bullish for a few days, and all of a sudden, this day opens, rallies up, goes past the previous high, comes down close below, the following day just capitulates. Okay, what is happening there is called stop-ons, and two things happening. Okay, they're just trying to get some fuel injection. So market makers, I call stop-on, is like fuel injection into your rocket engine. Okay, they know they want to go south. Okay, and they know some of these guys has been going up. They've been doing very well. They've been moving their stops to the low here, moving their stops. And some people who would like to continue going up because they got all the trade from the previous few days, breakout traders, taking out breakout trades. They were ready to break out over here as well. And this move, tiny move down as well, they've used it to entice sellers as well. So now you have two type of people here. You got people looking to continue selling. They've moved their stops to this very top here because the market has dropped before this new day open. Market dropped. They got that trade. And they also got buyers, breakout buyers. They will put something called buy limits at this level. So we have two types of money sitting here, okay? The type of money we have sitting there is called something called, the first one will be buy limits. Yeah, we call it buy limits because they're looking to break out, continue buying long. And then we got stops, stop loss, okay? Or sell stops. Right, these sell stops are for people who cut this move down. Maybe this is a 50 pip move or 30 pip move, whatever. They cut this move down and their stops is at the top. The bankers, market makers, they can see all of this. They can see the buy limits. They can see the stop loss. They can see all that. So they can see that, okay, we know that on this day, we want to go short. We need 100 million or 100 billion, sorry, to go short. So what should we do? Should we just open and then drop? No, we got a lot of buy limits here. Like there's 60 billion buy limits, and there's about 80 billion stop losses stashed over there because many people in the trading group, they already called it short. They've seen a trend line break or something. They already piled all their stop losses here. They see that and they know they want to go this way. So what they do, this is what stop on is about, is they pretend like they're going long. When they pretend they're going long, it triggers every buy limit. So all the breakout traders think, yes, the market is going again. We're going to make our mortgage money here. Awesome. Okay? They jump in to do that. And then it fools them. And then what happens? The people already with their stops at the top here, okay, with their stops there, all their stops are being triggered now. They're thinking, oh, I knew I should have taken profit when market was here. I knew I should have got out of the market. Now it's taking me out. Okay. So this fear, because when this price opens, it doesn't look like this. This is when it's fully closed. Look, it drives up out of fear, it stops some of those people out. Some of them will be bold enough to hold, but all this move will be so deep, it takes out all their stops, and they're afraid they don't want to be stopped out. And then the people looking to go long are really happy. The trader started to go positive. Now they move their stops from whatever it is, they move it to this low or another low in between this level here. They're thinking awesome, amazing. So we got two lots triggered. Now we got the buy limits and the stop losses there. What the market maker does is they came to fuel their $100 million, a billion um, engine with all the trades, the 60 billion and the 80 billion stop and buy orders. They trigger it, and once they do that, they move to the opposite direction. Boom, very aggressive, very, very aggressive. They move off. That what I just explained now is called stop hunt. Okay, they've come to hunt stops. Simple. Right. So now I can hear you say, okay, fair enough. If I see a wick to the top of a previous candle, that's stop on. But how can I identify? Okay, and we had two different kind of scenarios for stop on. The first we looked at was bullish stop on. But before I go on, let me explain the formula. There's a formula for bullish stop on. A bullish stop on is a spike low plus a market structure break. Oh, market structure break. Remember market structure break from the first session, from the first half? Remember, market structure break is when we have a series of higher highs or higher lows violated. Okay? If we see a lower low, at this point, that's a break. This move down, this point is a break because it's broken. If price move past this structure, that's a break. That's a market structure break. And if it's bullish, this is a structure, this is a structure. Okay? This move past this high structure is a market structure break. This is a structure. This move past this structure high is a market structure break. Okay? That should have been burnt in the back of your mind now. So the formula for stop hunt is this. Okay? It is simply a spike, high or low, plus market structure break. Okay? But let's break it down further. Let's break it down further. So this is what I mean. All you can see in this highlighted area, this two highlighted area, let me draw it out here for you, this level here. This is what it should look like. Okay. So this is what a market structure is. Market structure break for this sell scenario. Okay. So we would have, so you can imagine we've been having a series of higher highs, price has been going up. Price has been going up. So higher high, higher high, higher high. So structure high, structure high, structure high. Remember, these swing lows are structures as well. We have, remember, the three candle formation at the low this way, and at the top you have a reverse three candle formation like that. So finally, when they're ready to move, and what is happening in this small area, they then come on this day, they open and rally up. All the breakout traders jump in. They're like, yeah, we're going up again. All the people that caught this move down with their stops at the top there, they've been taken out. And then price did what? Came back down and did what? Look at this higher low over here. Okay. Went past that higher low. What is that called? Do you remember? When you go past a structure, what is that called? It is called, remember, market structure break. This that happened here is the confirmation that stop hunt is taking place. So if you do not have the complete equation or formula, you will not get this product. It's just like in chemistry. You have two reactants and they will give you one product. the reactant. For example, for water, you need oxygen, 2 molecules of hydrogen, and 1 molecule of oxygen will give you H2O, the product. So, in the same way, how do you make stop hunts? You need 2 reactants. The first is a spike. So if we're talking about a bearish stop hunt now, the first is a spike, okay, of a high, look, a spike of a high, plus a market structure break. Look, that's a structure, price went below it, it's a break. Once you have that, you have a stop hunt, okay? That is the formula. Simple and clear. This point, I would like you now to take your pen and paper again. I want you to draw what a stop hunt looks like. And I want you to label it. So I want you to say, this is a high, okay? That's a higher high. This is a higher low. Price comes past this level. This is a structure, remember, and that's a structure. We had initial market structure break to the top. Yeah, thinking we're going long, but it reverses and breaks the immediate low that appeared before this final high. Once that happens, that is a market structure break. So take the next 10 seconds. I want you to draw me a bearish stop hunt. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, 0. So you should have drawn that now by now, okay? So straight away I move to how a bullish stop hunt look like, okay? The formula for the bullish stop hunt is spike low plus market structure break. Simple. So let's change the way these candles look. Okay, let's change the way they look because we're looking bullish now. So we have this spike over here, and then spikes to low, and then we have the aggressive move. Okay, so we have this candle over here. It went past this previous low, this previous day low, or previous week's low, or previous H4 low, or previous month low, or previous year low. All of this that I'm saying is applicable across the board, across all the major time frames, okay? So formula for bullish, spike low, this is a low. Yeah, remember, this is a swing low. We have the 3 candle formation. Okay, here, price went past it, spike low, and then price went back up, okay? And in between here somewhere, it will have given us a market structure break. Let me draw that out. So, because we're looking at zooming this like a daily candle. So this is what you should look like. So we would have an initial low that was created. Initial low created. Okay, and then we have this low, spike it, and then we'll have a move up, and then price continues. So this is what the bullish one would look like. So here we go. We have the low, so that's a low. Price came to spike. So the same explanation I gave for what was happening in the stop one is the same for the bearish one. Is the same one for the bullish. Okay, let me remove this candle. Okay, so you can see we have this low over here. Price came down, formed a lower low. Okay, this is a low. It formed a lower low here, but we were thinking, the breakout traders were thinking, okay, it's going short. but then immediately price reversed. And in so doing, remember, what do we have here? This is a higher low. It's a structure. It's a 3-candle structure that looks like this. One in the middle and one to the left, to the right. Price goes past this structure. What is it called? It's a market structure break. And once that happens, the formula is complete. So a bullish stop on is spike low. So this is the low, spike to the low, plus market structure break. Market structure break. That is a stop hunt. Okay. So what I would like you guys to do now is I'd like you to please go in your favorite pairs and identify and label all the market structures and the stop hunts. I want you to label them exactly the way I've shown you. Spike low plus market structure break confirms confirming a stop hunt. You can go on any time frame. This happens across every time frame. Okay. Make sure you post it in the group. I'll be more than happy to take any questions if you do have it. And I'm sure that you practicing this will help you to see and understand the way we trade markets. Okay. So I hope you've had a good time in this session, and I hope I've been able to shed some light into your trading, and your trading journey is taking a positive turn. It's good night from me, and take care of yourself, and speak to you soon. Bye bye.